Okay, good morning and welcome to Saxo's weekly market insights call. I'm Charu. I'm a market strategist with Saxo Markets Singapore, and I will be running through some key highlights from last week and also what this week might bring, how potentially we can position for that. So my colleagues from Hong Kong and Australia are enjoying a long weekend, so they won't be joining in for this call today, and that means that you will have to bear with my long monologue, but I will try to stay as brief as possible. No promises though. Today, what I'm planning is that I will be discussing with you my top 3 worries for the markets for this week. So without any further delay, let's kick off with the most important event from last week, the UK crisis. Of course, that's been on everyone's minds. And of course, we want to know how it could develop further this week. So let's dig into that. I think the first key thing to understand here is that the announcements of tax cuts at a time when we are in this global tightening cycle and UK inflation is running at double digits, it hasn't really gone down too well with investors. We saw the UK yields rushing higher by about 100 basis points, and that kind of course, created some panic, understandably. Sterling dropped to record lows of 1.035 against the US dollar as well. And just after the announcement, of course, there were some hopes that, the Bank of England would probably come out with an emergency rate hike to defend its currency. But even those expectations were really smashed last week. And the officials that came out from the Bank of England only kind of hinted that they need to make some actions, but they said those actions would only be done at the November meeting. But later on, because of the pressure on UK assets, the central bank was forced to intervene by buying bonds, mainly because they wanted to prevent some of the pension funds from going bankrupt. And this did help to reverse some of the losses that we saw earlier in sterling and in the UK bonds as well. But potentially, I think this is a band-aid solution. Now, if the Bank of England continues to buy bonds now, that is a situation which is very similar to what we've been seeing in Japan, right? So that will further weigh on sterling because of the yield differential between the UK and the US as well. Assuming, of course, we will be seeing a lot more rate hikes from the Fed for now. So that will be a situation which is very similar to Japan, and we've already seen the impact of that on the Japanese yen. And on the other hand, if the Bank of England stops here, you anyway have a crisis situation. So this week, of course, the focus will be back again on what the UK does or what the Bank of England does. In terms of Bank of England particularly, market pricing is now looking for about 150 basis points of rate hikes for the November 3rd meeting. I think that's a tall order. 2 reasons. If they deliver that of course is a big hit to the economy. And if they do not deliver that, of course, you know what the fate of sterling looks like in a situation like that as well. So basically, it's not just a sterling crisis or a gilt crisis. It's a crisis of confidence that we are seeing in the UK economy. And the only ways I think this could reverse is possibly if we see the surge in US yields stops here somewhere, with the global pressure comes off. And that's potentially also what happened towards the end of last week, where the US yields were lower, and that's kind of took off some of the pressure from the sterling as well. But potentially, I think that was more an effect of quarter end rebalancing, because of the kind of run that we've seen in the US dollar over the last quarter. A lot of hedge funds and portfolio managers want to rebalance, and then that's the reason I think we saw some pressure on the US dollar and the US yields towards the end of last week. I don't know if that can continue this week as well. The second way for the UK authorities countries to reverse this could be by, of course, rolling back their fiscal policies. And lastly, if we do see some much wider market disruptions in the rest of the world, with the global withdrawal of liquidity continuing to break things, and we see bigger risks emerging in some of the other countries other than the UK particularly, I think that could take some pressure off as well. I mean, personally, I don't think any of that is happening right now, not in this week particularly. So that possibly means that there will be more pain for the UK economy and further pressure on sterling and gilts this week as well. And the other thing I think that we really need to be watchful of is how wide these market disruptions could spread, and potentially also who is next. I mean, of course, I think this global withdrawal of liquidity is certainly breaking things now, and we will see this turmoil expanding as well. So could it be Italy? I don't know. Maybe, I mean, that could destabilize the EU as well. I certainly think pain is coming more and more so for Europe at this point, as they head into winter without enough supply of gas, with inflation, at such high levels, and now with these troubles in the financial markets as well. I would think a lot of these European countries will want to use their public balance sheets to shield private households and companies from the huge increases in energy bills this winter, and how that plays out in the markets is going to be certainly something to watch in the fourth quarter as well. The second key thing that's really making me nervous for this week is the geopolitical situation. So after we had Russia annex 4 cities from Ukraine and they claimed them to be Russian territory now, parts of these have actually been recaptured by Ukraine over the weekend. So Russia is losing key military ground. And as we enter October today, this is the key month for Russia also to press ahead further with the energy crisis, especially for Europe, with the winter demand kind of picking up. So I see, two big risks here. I'm not sure how, but Russia could press Europe's energy nerves further. I think probably by also halting supplies from Ukraine as well. And secondly, I think this is a big threat of use of some of the low yield nuclear weapons. It is looking likely given how desperate Russia is now. So these developments could, we could see over this week, and that could spur a lot more risk off as well. Potentially, again, like we saw earlier, in February when the war broke out, the effect will spill over to energy, to agricultural markets. So think oil, think gas, wheat, soybeans, and the likes. And on oil particularly, if I just talk about that separately, remember that we also have the OPEC Plus meeting this week on the 5th of October. And there are some reports that are suggesting that members may be considering an output cut of more than 1 million barrels per day. So that has already meant a 3% jump in oil prices this morning. And as this story develops further, as we get the numbers from OPEC Plus later on in the week, I think that could play out on the oil prices further. And of course, not to forget, we still have the demand concerns playing out with China's zero COVID policies still in place and the global tightening race also still on. But in the long term, I think, as Saxo's view has been, we continue to be worried about the supply situation in the energy markets and even in the agriculture markets more than the demand conditions here. Moving on, the third key worry I want to share today is of course, the upcoming earnings season. We are still 2 weeks away from that, but nonetheless, I think it's a point where we will start to see a lot more news on that front. Last week itself, we had warnings from Nike, from H&M, Apple, and the likes. So I think these profit warnings could ramp up ahead of the upcoming earnings season as companies and analysts revise their estimates. So what is really happening is that energy shock is now translating into a cost of living crisis in most parts of the world. And that means that consumption will come under pressure and companies will not be be able to pass on higher costs, as it did until the second quarter, because the pandemic budgets were still supporting the consumers in a big way until then. So that's just a quick warning. I mean, I think we will chat a lot more about the Q3 earnings season in the coming week as well. And we have written a lot of articles on that too. So just check that on the platform. Possibly you could go to the stocks section in the research tab on the platform to see more articles on the earnings season particularly. And we've talked there about the kind of margin pressure that we are expecting for this season. So that's something to consider. And finally, one last point from me today is about the US and the Fed. Of course, we can't have a discussion without touching upon those things at all. So generally speaking, I think we are getting a lot of positive data on the US economy. If you consider what we saw last week in terms of consumer confidence, or the sub 200K print in weekly jobless claims as well, I think overall suggesting that the US economy and the labor markets particularly are still quite strong and still remain in a position to weather some more rate hikes from the Fed. We also had the PCE data on Friday, which was again still higher than expected on the core measure and kind of paves the way for another upside surprise potentially in CPI later this month. And we had a lot of Fed speakers as well giving comments last week, all generally hinting that tightening is set to continue and not being worried about the US economy or even the strength of the dollar or, the crisis in other markets. The US officials have shown so far no concerns that any of those crises or the strength of the dollar could potentially slow down their pace of rate hikes. So I think that, of course, is a very clear signal that they are quite focused on getting inflation under control. What we get this week will be the ISM, manufacturing today, services on Wednesday, but most importantly, of course, the payrolls data that is due on Friday from the US. I think the expectation in terms of, Bloomberg consensus is about 250K, which is, of course, like a little bit of a slowdown, or rather, I would say moderation from what we've seen previously, but still a pretty healthy pace of growth in the labor market and quite a tight market still. Unemployment rate will, of course, be on watch as well. Expectation is 3.7%. And as Fed hinted at, in its dot plot in their September meeting, even some gains in, even a little bit of a higher unemployment rate is not really going to deter them from their rate hikes right now. So the key question for this week will be if that surge in US yields and the US dollar could return after easing a little bit into the late last week. The dollar wrecking ball has been in full swing around the globe, and we saw Bank of Japan intervening the week before last. Then last week we had the Bank of England and the PBOC also joining the intervention party. But these interventions never really have a long-lasting impact. So you generally want to be short on the currencies that could weaken further if the dollar momentum returns. So I think these are some of the things that you should potentially have on your radar for this week. I'll stop on that note. Stay safe. We are at a point now where something might break after the Japanese yen and the UK credit markets, as we discussed. So be prepared for the next shock to come. I think also on that note, I would mention that Saxo strategy team will be launching the Q4 quarterly outlook this week. We have a range of events scheduled around it. So for folks in Singapore, we have a VIP roundtable in our office tomorrow. You can get in touch with your sales rep for that. And if you're in one of our other locations as well, we will be hosting online webinars as well. I think one is scheduled for Wednesday, and you can register for those on our platform or also on our website. And that's it from me today. Do not hesitate, of course, to reach out to any of us at Saxo if you need any assistance with your trading or your investment journeys. Have a good day and good week all. Thank you for joining in.